Hey everyone, welcome back to Corporate Decoder, the place where we untangle those corporate filings to give you the real story behind the numbers. Today we're diving into an update from Rocket Companies Incorporated, specifically looking at some financial agreements they've been working on. Rocket Companies Incorporated has filed a current report detailing some important financial updates. Think of this like a quick check-in on the company's financial health and ongoing deals. Now, what is this all about? Well, it seems Rocket Mortgage LLC, a subsidiary of Rocket Companies Incorporated, hammered out an amendment, a kind of variation to an existing master repurchase agreement. What does that mean in simple terms? Imagine a big loan deal, but specifically for buying mortgages. This amendment basically tweaks the terms of that big loan. The main players here are Rocket Mortgage LLC as the seller and Morgan Stanley Bank N.A. as the buyer. It is a partnership essentially that helps Rocket Mortgage keep its operations running smoothly by providing necessary funds. The core of this is a master repurchase agreement, a common financial tool. Think of it as a deal where Rocket Mortgage sells certain assets to Morgan Stanley Bank for a short period and agrees to buy them back later. This is a way to get quick access to cash. This latest amendment extended the expiration date of the existing agreement. So instead of wrapping up in late 2026, it will now go until late 2027. This gives Rocket companies more stability and predictability in their funding for another year. They also made some other minor adjustments, or what they call technical changes, which are usually just fine-tuning the language of the contract. Now here is the really interesting part. After this amendment was put in place, the total amount of money Rocket Companies can access through all its various funding sources remained steady at $26.4 billion. This is a crucial number. It means that even with this change to one specific agreement, their overall borrowing power or their capacity to fund their business operations has not decreased. This figure is the same as it was at the end of September last year, and it is a bit lower than it was at the end of 2024, which stood at $27.5 billion. So there has been a slight dip in the total available funds, but it is stabilized more recently. Why is this significant? For a company like Rocket Companies, which is heavily involved in originating and servicing mortgages, having this robust funding capacity is absolutely vital. It is like their lifeblood, enabling them to buy mortgages from homeowners and then sell them on the market or hold them. A stable and substantial funding line means they can continue to respond to market demands, and fulfill their client obligations without interruption. This report also touches upon regulatory filings, and it mentions Rocket Companies Incorporated is incorporated in Delaware, a common place for companies to register. They also list their stock ticker symbol is RKT, which is traded on the New York Stock Exchange. This is just background information letting investors know where to find their stock. The report is signed by Noah Edwards, the Chief Accounting Officer, which is standard procedure for these kinds of filings. It shows the company is formally acknowledging and filing this information with the relevant authorities. Now let's put on our analyst hat and look at the bigger picture. Rocket Companies operates in a very competitive and interest rate sensitive market. The fact that they've managed to extend a significant funding agreement with a major bank like Morgan Stanley is a good sign. It suggests that despite market fluctuations, their financial partners still see value and stability in their business model to commit for a longer term. The total funding capacity remaining at $26.4 billion is a strong indicator. It means they have the resources to continue their core business. While the slight decrease from $27.5 billion at the end of 2024 might seem like a concern, it is important to remember that these funding capacities can fluctuate based on market conditions and the company's strategic decisions. The key takeaway here is stability and continued access to substantial capital. One notable risk for any company in this space is the impact of rising interest rates. Higher rates can cool down the housing market, affecting mortgage origination volumes. They can also increase the cost of borrowing for the company itself if their funding agreements are tied to variable rates. However, the extension of this agreement to 2027 provides some insulation against short-term interest rate volatility for this specific funding source. Looking ahead, Rocket Companies will need to continue to demonstrate its ability to manage its risks effectively, especially those related to market volatility and regulatory changes in the financial services industry. Their success will depend on their agility in adapting to changing interest rate environments and maintaining strong relationships with their funding partners. This latest filing is a positive step showing they are proactively managing their financial structure. Overall, this update is less about a sudden dramatic shift and more about the ongoing diligent management of Rocket Companies' financial infrastructure. The extension of the agreement and the consistent high level of funding capacity are positive signals for continued operational stability. Alright, that is our breakdown of Rocket Companies Incorporated's latest filing. What is your take on these financial agreements and what they signal for the company's future? Do you think they are well positioned in the current market? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out our Discord channel linked in the description where we discuss these topics further. Thanks for watching, see you next time.